What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, we're going to revisit the real estate professional status. We've been covering quite a few court cases involving real estate professional status. So I'm going to go back and discuss the rules and what real estate professional status really is and what you need to do in order to qualify, because it really is, real estate professional status is the holy grail of tax planning for real estate investors. This is going to open up the door to some of the best possible ways to save money on taxes when you're involved in real estate. But not everyone qualifies, and it's easy to get it wrong. So let's just start with a quick review of the passive activity loss rules. So these are governed under Section 469 of the Internal Revenue Code. So every activity in the eyes of the IRS is either passive or non-passive, not passive or non-passive. And passive activities come with rules that limit your ability to deduct losses. So back in the day, before 1986, anyone could invest in real estate and deduct their losses against their active income, their W-2 income, active business income. So great time to be a real estate investor. Then in 1986, there was a huge tax bill passed, and included in there was a passive activity loss rule. They viewed some of these investments, especially in real estate, as a tax shelter. So passive activity loss rules say that any business that you do not materially participate in is a passive activity, and rental activities, whether you materially participate or not, are passive activities. And passive activities, the losses generated from them can only be used to offset passive income. So if you have two rental properties, for example, one has income and one has losses, you can net the losses against the income of the other rental. However, losses in excess of all your passive income are suspended and carried forward to offset future passive income. Now, the default classification for rentals, that's often referred to as the per se rule. So when you hear someone say rentals are passive per se, that's what they mean. It's by default, even if you materially participate, or other businesses, passive if you do not materially participate, but if you do materially participate, then they're non-passive. Now, what exactly real estate professional status is, all it really is an exception to the rule. So the default classification for your rental properties is bypassed when you qualify as a real estate professional. And that allows you to deduct your real estate losses against your non-passive income. However, to qualify as a real estate professional, there's two hurdles you need to clear, or two tests you need to pass. So the first one is more than 50% of your time needs to be in real property trades or businesses in which you materially participate. So you have to materially participate here. We'll talk more about that here in a moment. The second test is at least 750 hours need to be performed in real property trades or businesses in which you materially participate. If you are filing a joint return, one spouse has to pass both these tests. You cannot combine your time here to qualify as a real estate professional. Now, there's a lot of discussion about what hours count. This is where I see a lot of errors. So the hours that you're going to count have to have a material impact on the operations of your real estate business. So you have to be performing services or actually doing something. If you are simply observing contractors do the work, that's not going to count. Those hours won't count. Education and research hours, that does not count because it doesn't have a material impact on the operations of your real estate business. Travel time, that's also not going to count. Yes, there's a court case or two out there where some travel time's been allowed, but that's the exception to the rule. And odds are, unless you have a really nice auditor, you're going to have to fight that in court to prove it. So your travel time, just bank on qualifying without those travel hours. If you want to record them to show like how much time you're actually working in your real estate business, fantastic. But make sure you hit that 750 hours and more than 50% of your time without relying on your travel time. Now, we keep referring to real property trades and businesses. So there's 11 of them provided to us in the Internal Revenue Code. We have development and redevelopment. So you're developing properties, or maybe you're tearing down old properties and develop, or land, whatever. You could be tearing it down and redeveloping. You have construction and reconstruction. So you're building houses or buildings or reconstructing them. You have acquisition, conversion. So you're converting a type of real estate from one use to another. Rental, brokerage activities, which under brokerage you can qualify if you're a real estate agent. Jobs like mortgage brokers are not going to qualify. Businesses like a mortgage broker. Leasing, management, operation. These are your real property trades or businesses. So it has to be in one of these where you spend more than 50% of your time and at least 750 hours. Now, one thing to know if you are in one of these real property trades or businesses, to count your time, you have to own at least 5% of the company if you're working there as an employee. So some operations are structured as an S Corp or a C Corp. And even you as the business owner will be on payroll and receive a W-2. If you have a W-2 from the company, you have to own at least 5% in order to count your hours. If you're simply an employee with no ownership, your hours are not going to count. So for example, if you work for a construction company, you're paid on a W-2, but you don't own any portion of that company, your time working there is not going to count towards real estate professional status. Now, let's say you qualify. Okay, you're certain you're a full-time construction worker. That's your business. You own the company. Your hours are going to count, and you can just write off your losses now, right? Not so fast. So you've cleared the two hurdles, more than 50% of your time, and at least 750 hours in real property trades or businesses. Now you have to demonstrate material participation in your rental activity in order to deduct those losses. So you need to have material participation in your real property trade or business, but if you want to deduct your rental losses, you also need to materially participate in the rentals. Because remember, real estate professional status gets your rentals out of the default passive bucket. Now it's going to be looked at just as any other business. So you have to materially participate or it's still passive. So you can say there's 3 tests. You spend more than 50% of your time in real property trades or businesses. You spend at least 750 hours in real property trades or businesses. And you materially participate in your rental activities. Now you can deduct those rental losses. Now, material participation. What exactly is it? So participation generally means any work done in an activity by an individual who owns an interest in that activity. So again, the ownership interest, key here. Material participation means that you're involved in the operations on a regular, continuous, and substantial basis. Now, the regulations give us 7 tests that can be used to demonstrate material participation. So these can be found under Treasury Regulations 1.469-5T. So the 7 tests we have are 1, you participate more than 500 hours during the tax year. 2, your participation is substantially all the work. So you're basically doing everything yourself. Third test is 100 hours and more than anyone else. Now, those are the 3 primary tests you'll see used by real estate professionals to show material participation in the rentals. There's others, so it could be a significant participation activity that, when combined with all other significant participation activities, totals more than 500 hours. Significant participation activity is some activity where you work more than 100 hours during the year and you don't qualify as materially participating under any other test. There's, if you've materially participated in any 5 of the preceding 10 tax years, whether or not consecutive, you're considered materially participating in the current year. But remember, you have to get those first 5 years in first. There's a facts and circumstances test. So you participate more than 100 hours and based on all the facts and circumstances. That's test 7. It looks like I skipped over 6, so material participation in a personal service activity for any 3 years. Not going to apply to real estate because personal service activity in this case means something like work in the fields of health, law, engineering, accounting, as professional service type activities. So tests 1, 2, and 3, your 500 hours, substantially all, and 100 hours and more than anyone else. Those are the 3 primary tests that, or at least the most common, that we're going to see used to demonstrate material participation. Test 7, most difficult to prove. That's the facts and circumstances test. So generally, It's really difficult to prove test 7. You also need 100 hours. So if you've got 100 hours and more than anyone else, you should be going with test 3, 100 hours and facts and circumstances. There's just too much wiggle room for the IRS to go in there and deny stuff. I'm not saying it's impossible, but it's really difficult to prove. Now, for purposes of material participation, your spouse's time does count. So now you can combine time with your spouse. So the first 2 hurdles for real estate professional, more than 50% of your time and 750 hours, that has to be by one spouse. But on a joint return, you can combine your spouse's time for the material participation tests. Now, by default, every activity, meaning every rental or business activity, you have to demonstrate material participation in each one. They're looked at by themselves. However, for real estate professionals, there is a grouping election for your rental properties. So you can combine all your rental activities into a single activity. That way you only need to show your material participation in aggregate for all the activities combined. It would be very difficult to materially participate in multiple rental properties. If you own 10, 20, 100 properties, it would be sometimes impossible to materially participate in all of them on an individual basis. But by making the election, you group them together. The election is made by attaching a statement to your tax return, and then it's binding for future tax years. So just to recap, real estate professional status is what allows you to take your passive rental losses and use them to reduce your non-passive income. To qualify as a real estate professional, you must clear the 2 hurdles for work in real property trades or businesses, meaning more than 50% of your time in real property trades or businesses. Forget about passing that test if you have a full-time W-2 job. Second test is at least 750 hours in real property trades or businesses. After clearing both of those hurdles, you need to demonstrate material participation in your rental activities. Typically done by participating 500 hours or more, test 1. Substantially all, so you do everything yourself, test 2. Or 100 hours and more than anyone else, test 3. And finally, group all of your rentals into a single activity, so you only need to show material participation in the aggregate. So that's sort of a high-level look at real estate professional status, what goes into qualifying, and it's really, really important to have documentation. This is a highly litigated area of the tax law, so you need to have, it's not required by the regulations, but it will be asked for in the event of any audit, and it's going to make things go way smoother. You need to have a time log for your 750 hours for your real estate professional hours. You should also have a time log for your material participation in your rentals. Without those logs, IRS is not going to view you as very credible. Make sure your laws are correct and factual. Don't make things up. Don't record hours when you're on vacation overseas. Don't say you're working at your rental property. They'll be looking at credit card statements and other things too. And if an auditor sees a discrepancy in what you're saying on your time log to some other piece of evidence, they can easily throw that out and disallow it. So just make sure you've got all your ducks in a row. You've got good documentation for your hours, for your expenses, and then everything will go smooth. Well, that about does it for today. I hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. And until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.